What's going on, everybody? Ryan Pineda here. In today's video, we're going to be giving you 5 tax loopholes that you probably haven't heard of. If you didn't know, I actually own a CPA firm called TrueBooks, and I've got my partner Matt here, who is the licensed accountant over there, and he's going to be explaining all 5 of these loopholes, how to legally do them, and whether you'll qualify or not. So Matt, let's go over loophole number 1.
So the first loophole is actually paying your own children within your business. Overall, you can pay your kid $12,000 and because the standard deduction is $12,000, that income to them can be completely tax-free.
So essentially, instead of me taking that $12,000 in income and paying whatever my tax bracket is, now I can just pay my kid instead and wipe out taxes on $12,000.
Exactly, because the government gives you a freebie called the standard deduction, which is, I believe, $12,400 to be exact, but for round numbers, you pay your kid $12,400, they get the standard deduction for $12,400, it zeroes out their taxable income, and there's no tax.
Okay, so how would that work? Like, what if I wanted to pay my kid out of, TrueBooks or Future Flip or any of these companies I own?
So that's fine, you can pay your kid directly from your company, but what you wanna make sure you do is the money has to go to an account in their name, and they have to actually perform services for the business. So keep a logbook, maybe they're sweeping around your building or helping you with mailers or whatever that may be, just keep a log of what they're actually doing.
Okay, here's another follow-up question. Could I pay my kid from multiple companies, or now they just make over 12 grand, so they're gonna have to pay tax?
Exactly, so they would break that standard deduction threshold, whereas if you keep it right at that level, the standard deduction will wipe out their income to where it's zero.
Okay, but theoretically, if I'm in the 40% tax bracket, I could pay my kid more than that so that they're at a lower tax bracket.
Exactly, so that's what we call income shifting. So you can take some of your income, pay it to a family member, and then now you're shifting down some of that income to a lower level tax bracket.
Okay, that makes sense. Now, as far as a kid goes, like what's the age that I can start paying these kids? Can I pay Olivia, who's 8 months old? Can I pay JP, who's 2 years old? How does it work?
So I would say yes, if you can find certain things within your business that they can help with. For someone that young, probably would be advertising, slapping a onesie on them or something, putting them in some sort of media.
Yeah.
But I've actually seen IRS rulings where they allowed a 7-year-old to sweep floors and make, a pretty decent wage.
So if I threw a TrueBooks, onesie on JP or Olivia, and I basically use them as advertising for the company, that's a legitimate expense?
Yes.
I'm actually super surprised you said that because most accountant videos will not give a definitive answer on anything, but hopefully you guys appreciate what we're willing to do because this is what other people do. They just don't ever talk about it. All right, so let's jump into loophole number 2.
So loophole number 2 has to do with the type of accounting that you do in your business. So there's 2 types of accounting, cash versus accrual. Somebody with inventory typically will run on the accrual method, meaning if I buy inventory in year 1 and don't sell it until year 2, I don't get the expense technically in year 1. But if I choose to take the cash method of accounting, I can actually write off those expenses even if I didn't sell the inventory.
So the way we currently do it now is through the accrual method. I buy a house for say $200,000, I put 50 grand in it, and I will not deduct any of that until I sell it, whenever that sale happens. And if it happens to be the next year, that's when I'll take it. But if I were to use the cash method, I would take all those expenses the moment they happened. So if it happened in 2020, I would take 250 grand of expense in 2020, but then in 2021, I'd have a 300 grand gain when I sold it.
Exactly, so that's why we typically will run the accrual method to keep things even. You write it off when you sell it. But if you're a small business and you deal with inventory, sometimes it's better to take those expenses in year 1 to drive a loss because maybe you have other income that you want to offset. So using the cash instead of the accrual method can really help your situation.
Yeah, and I think it just really depends on your specific business. Like for me, I wouldn't want to have to pay $300,000 the next year because I took all of this loss this year. Because I know that I'm flipping the property, I'm gonna have to pay it no matter what. So, for me, the accrual method works, but really look at your business. The cash method might be better.
And I will say there's one caveat to that. You can't actually run on the cash method of accounting unless you're considered a small business. This first test is a $25 million gross receipt test. So some home flippers won't meet that. The sale price of a home is a couple $100,000. Typically this is for people doing eBay, Amazon, e-com, stuff like that.
Well, I would also guess that 99% of people watching this video are not, doing $25 million a year in sales. So I would assume many of you might benefit from this. All right, let's jump into number 3.
So number 3 has to do with capital gains tax, and specifically long-term capital gains. So long-term capital gains differ from short-term, and the difference is the time period of which you held that asset, 12 months.
Now, I'm certain that many of you watching this already know what short-term versus long-term capital gains are, and you're thinking, Ryan, that's not a loophole. Like, everyone knows what that is. Where the big loophole comes in is how you structure your deals, because there's many people paying short-term capital gains on things that they could have made long-term if they structured properly. Why don't you tell them about how to structure certain ways?
So for example, if you're gonna partner up with somebody, instead of maybe being an employee and having earned income that is subject to self-employment tax, maybe you take an equity position as an owner in the company, therefore you hold stock in the company, and then over time when the company sells, you realize a long-term capital gain on the stock that you own. So if you hold it for more than 12 months, you would get long-term capital gain treatment. And why that's preferential is long-term capital gain rates are much lower than short-term capital gain rates, which are really just ordinary rates, normal federal tax bracket rates.
And there are a bunch of other ways to creatively do deals, whether it's in real estate, whether it's in business, whether it's in your own taxes when it relates to capital gains. So if you want to figure out how to best save money in your position, definitely go schedule a call at truebookcpa.com and we can talk you through that. All right, let's jump into number 4.
All right, this one's exciting. This is bonus depreciation. So I don't care if you have a rental property or your own business, this is something huge that almost everybody can take advantage of.
All right, first off, explain to everyone what depreciation is.
So depreciation, when you buy an asset, let's say you buy a car, you don't just write off the whole value in year 1. Typically, you will have to depreciate it over so many years. A car is 5 years. So if you bought a $50,000 car, you would take $10,000 for the next 5 years as a deduction. But with bonus depreciation, you can take it all in that first year.
And a good example of that would be my Tesla. I paid around $90,000 for it. And one of the big reasons I did it was so that I could bonus depreciate that $90,000 in 2020. So that's $90,000 that I just wiped out from my taxable income by buying a car.
And the best part about that is you don't have to pay cash for the car. You can walk out of the dealership financing 100% of the purchase price and still get bonus depreciation.
Now, obviously the car thing is cool, I've used it, but the real benefits to depreciation are through rental properties. Tell us how it works with that.
So with a rental property, when you buy a home, and let's say you put some money into it, you're not just buying the home, you're buying the land, and you're buying the assets within the home. Now, depreciation can be very confusing, so I'm gonna try to explain this best I can. When you buy a rental property, you're not just buying the home itself. You're buying the home, the land that it's on, and all of the assets in it. There might be appliances, there's carpet, there's paint, there's windows, and things like that. The windows, carpet, and paint, all of that can be bonus depreciated because it's an asset with a small life, typically 5 or 7 years. The actual structure of the home is 27.5 years. So all of the property that you can identify within that rental property that's 5 or 7 years, you can bonus depreciate in the first year.
So essentially for a normal remodel with paint, with carpet, with bathrooms, with kitchen cabinets, all of that stuff, I could bonus depreciate, meaning I can take it year 1 and write that all off against my taxes.
Exactly, against your rental income.
Right.
Therefore, driving a loss.
All right, so that loophole is gonna be the one that really helps me out the most this year in 2021. But I think this next one is gonna be a big thing for most people watching this. Why don't you tell them about loophole number 5?
So now what we wanna talk about is the AUGUSTA rule, which is IRS Section 280A. This states you can rent your home out for 14 days a year and not report the income.
And you could rent it out to anyone. Doesn't matter if it's your business, it doesn't matter if it's your friend, your family, whatever.
Exactly. And typically, when you receive rental income for a rental property, it's reported on your tax return and you pay federal income tax on it. But in this case, if it's a short-term temporary rental for 14 days, you don't have to report the income.
So the way that I see people usually do this is they have their business rent their home from them because they're gonna be doing some type of business retreat, maybe they're doing their quarterly meeting, their monthly meeting, whatever the case may be, and their business will pay them the agreed upon amount, and they'll make that income and pay no tax on it, and then their business will get a deduction and an expense for paying them.
Exactly. So look at this in 2 parts. So if you own a business, your business can rent your home from you for a fee, and that is deductible to your business and tax-free income to you. On the other hand, if you just own a home and you want to rent it out for up to 14 days, that also is income to you that is not taxable.
So how do you determine what is a fair amount to rent the home for?
You would look up other homes in your area, similar square footage, almost like a comp, and you would see what other homes are going for.
So essentially, if I just went on Airbnb, I could go look at what these types of homes are renting for on a nightly basis and charge that amount.
Exactly. And where this came from was the AUGUSTA rule. That's what we call it, is because the golf course, people wanted to leave and rent their homes out when the tournament would come to town. And it ended up becoming a tax code to where for that short time that they are rentals, the income is not reported.
So to give a real world example, if my house can rent for $1,000 a night, I could do that 14 nights out of the year for my business, and that's a $14,000 deduction I now don't have to pay any tax on.
Exactly.
But what will be even better is when I finally build my house on the mountain, because what's the nightly rent on that thing? Maybe it'll be, $5,000 a night, $10,000 a night, and then you're talking about a really big deduction.
Ryan would rent his home out to his business and have an annual or quarterly meeting.
And we are definitely gonna do that because there are gonna be some crazy parties at that mountain.
And there will be a video on it.
And there most certainly will be a video on it with the proof, and everything that I do at that event will be written off as well. But anyways, those are 5 tax loopholes that you probably haven't heard of that you could probably take advantage of in your life, in your business today. Want to thank you again, Matt, for coming on the channel. People love it when they hear from the CPA. If you want tax advice, you want tax help, we can for sure help you at TrueBooks. Go to truebookcpa.com, check us out, go book a free consultation. We're happy to help you any way we can. If you got value out of this video, also go hit the like button, make sure you're subscribed. Go subscribe to Matt's channel as well. Until next time, peace.